Welcome to the first edition of our House Views podcast. I'm Geoff Dohrmann with Institutional Real Estate Inc. We're going to be recording these on a quarterly basis with the principals of some of the leading global and regional placement agents to learn their views on the markets and sometimes specific aspects of the markets. We hope you enjoy viewing them. Today's podcast is with Rob Kohn, a principal with New York-based Park Madison, the firm founded by Nancy Lachine. Welcome, Rob. Why don't you tell us a little bit about Park Madison?
Great. Thanks, Jeff. And really appreciate you doing this and very excited to be in the inaugural part of this program. Pretty excited about it. So Park Madison's a business that's been around since 2006, always been in the real estate, real assets business. We see ourselves as an advisory boutique. We work with GPs, LPs to help aggregate capital around really high quality opportunities that the GPs bring to us. We have raised roughly $30 billion since the business was founded, which we feel pretty proud about. We've always been a privately owned business, a business owned by the partners. So we wake up every day thinking about what we can do for our clients and really feel that we're uniquely positioned to help them since we are entrepreneurs ourselves and we work with a lot of entrepreneurs being a partner-owned business. We have a very privileged position in the capital markets because we have a placement business, which is we raise capital for primary funds as well as open-ended funds, but we also work with GPs to recapitalize portfolios, structure JVs, and we feel that given those two lines of business, we get to see the entire quantum of the investor base from small RIAs all the way up to the large sovereign wealth funds, investment management funds, and everything in between. Last year, or in the past 18 months, I think we had 391 unique GP meetings. So I would say that gives us a pretty interesting perspective on what GPs are looking for. And then we would more than double that on the LP side.
And like a lot of placement agents, you guys publish our annual market outlook and investor appetite report.
Correct.
How would you characterize current investor sentiment towards real estate and infrastructure strategies globally?
So I'd say since 2022, the market's been rough, right? I think we all know that. Anybody who's been in real estate knows that the market's been rough since 2022. I think that we were pretty excited headed into 2025. The mantra was what? Stay alive till 25. Since 22, the end of 22, 23, 24 were tough. There were certain headwinds that I don't think anybody could predict it that happened in 2025 that made 2025 more muted than we all would have liked. But I would say from what we see on the ground and everything you hear that 2026 is going to be hopefully much better than 25 was. And we started seeing that towards the end of 25 in the past 3 months, I would say. Investor sentiment and engagement has gone up significantly. And it's not surprising that folks were a little hesitant about real estate, right? I mean, interest rates went up 500 basis points in a investment that is very real estate dependent, interest rate dependent. So I think the shine was off real estate a little bit, but I think real estate's settling back into where it has been in the past in investors' portfolios, which is somewhere between equity and debt and something that really creates cash flow and inflation hedge for investors. And I think a lot of CIOs are going to wake back up to the fact that real estate is a great diversifier in their portfolios and something that has always had a place in portfolios and will continue to have a place. So I'd say from where we sit, we're pretty darn excited about 2026.
Are you starting to hear that from CIOs?
Yeah, I mean, we're definitely starting to see a lot more interest in the real estate space than we had in the past two and a half years. And there's lots of reasons for that we could get into.
Now, investor sentiment tends to shift around in terms of what's attractive from a property type standpoint. What's resonating with investors today?
So I would say the most interesting, so industrial and multi have been the darlings, right, of the industry for the last 3 to 4 years. What's interesting is data centers. I mean, I was looking at the data and data centers were sort of nowhere on the fundraising information in 2024, in 2023, 2024, depending on what you look at, it was like 10 to 13% of the capital raised. And in 2025, the latest numbers I saw was 31%. That's a huge increase. So I think data centers has eclipsed all property types other than multi for being most interesting to investors, which I think speaks to a lot of different things. But I think the digital infrastructure play is very interesting to folks. And I think anything that's part of that digital ecosystem is going to get the support of CIOs, right? And at the end of the day, we're not using these things any less, right? We're not engaging with technology any less. We're just doing it more and more. So I think that tailwind makes a lot of sense.
How about niche strategies? What niche strategies are resonating with people? We saw a real interest in life sciences a few years ago. That's kind of waned. What's hot today?
So on the niche strategy side, I would say a lot of it is what we would call multi-adjacent or industrial adjacent, right? Multi-adjacent, senior housing, student housing, BTR though, given some recent movements by the administration. We'll see what happens with some of those things that look like single family housing, but we still have seen a lot of interest in BTR. We've seen a lot of interest in the industrial adjacent, iOS, anything having to do with data centers. I would used to call data centers industrial adjacent. Now it's become its own property type. So separated out from the industrial adjacent space. Any industrial with power seems to be interesting. So I would say that anything that kind of rhymes with industrial or multi is of most interest these days. And then you also get into where infrastructure and real estate are starting to combine, where a lot of groups now have a real assets bucket that they're investing out of, that they can invest between infrastructure and real estate. And I think that's getting a lot of legs, and a lot of the infrastructure plays or traditional infrastructure plays look a little bit like real estate and vice versa.
You've talked a little bit about the investor shift that's taken place in terms of, being more interested again in real estate. How do you expect investor appetites to shift over the next 12 to 24 months, given various macroeconomic conditions, and things you've already mentioned, interest rates, inflation, geopolitical risks?
So I think things are settling down. I've been doing this since 2004, which makes me a lot older than I'd like to admit, but I've been doing this since 2004. And over that time frame, we've gone through different cycles and we've had different real estate markets, but we haven't really been in a regular way real estate market since 2019, right? And I feel like we're getting back to that regular way real estate, where I said before, real estate as a plays a position in a lot of people's portfolios as a diversifier and as an inflation hedge. We are getting back to that. I think folks are waking up to the fact that interest rates are going to kind of be in that 4 to 4.5% range for the foreseeable future, and need to figure out how to make money in real estate and get back to the basics, which was working real estate to create income and hopefully some appreciation, right? When you had zero interest rates, appreciation was so significant that everybody sort of forgot about that cash flow component that's supposed to flow off of real estate. And I think we're getting back to that. And I do think that there will be hopefully some tailwinds here that will push interest in real estate to greater heights in 2026 and through 2027 beyond. And going back to that convergence of real estate and infrastructure, the lines are getting blurred. And I think that's only good for real estate, because the amount of money that's been pushed towards infrastructure has been pretty significant. And if the real estate plays can capture some of that, that would be a great thing.
Yeah. How about debt? We haven't talked about that. What's the appetite for real estate debt? It was really hot for a while. It was kind of like private credit and infrastructure were the two hot sectors.
Yep.
Is that changing at all?
So we don't do a lot in the debt space for various reasons, which we could get into. But I would say with regards to what we see and hear from investors, there was a lot of interest in the debt space as interest rates were ticking up, as equity portfolios were a bit scary, as folks couldn't sell assets. I think a lot of folks went into the debt trade. I wouldn't say the shine's completely off the debt trade, but I think equity trade is caught up, and there'll be more allocating towards equity and a little away from debt, because I think folks have filled their boots with their allocations into the debt space.
So let's take a little deeper dive into the fundraising environment. You've talked a little bit about it, but let's go in a little more detail. How would you describe the current fundraising climate compared to 12 months ago, and the outlook moving forward for the next 12?
So I think the fundraising environment, as I said before, in the past 3 months has felt a lot better than it felt headed into 2025. It actually felt pretty good, but then given certain things that happened, the shine came off the fundraising, and we hit a bit of a lull in the middle of 2025. But if you go back and look at what brought us to this place, I would say everybody thought, oh, 2022, you hear that huge spike in inflation, right? From the May inflation number printed in June. And I remember we were working on several things that were just dropped, right? We're just on the recapitalization side of our business. We had a multi-portfolio that we were in a LOI negotiating, and the buyer, the day that number printed, said, we're pausing on real estate, right? Because of how impacted they knew the real estate business would be from what was going to happen with the Fed raising interest rates so quickly. So I think that made a lot of investors pause, right? And the other aspect that people forget about is 2022 was a huge fundraising year. So a lot of investors put a lot of money into real estate in 2022. So we would have a lot of managers who come to us and say, why aren't investors participating here? There's going to be all this, the real estate market's going to be disjointed. There's going to be a lot of opportunity. Said they are participating, but they made those commitments, a year, 2 years ago in 2022, and they're just waiting for that to play out. And the other issue was the distributions just were cut back significantly. Yeah. And from where we sit, the number one thing we hear from investors across the board, and this has always been the way since the beginning of time, is transparency, right? That's what they want the most out of their managers. But the second thing we've been hearing is distributions, right? And if you look in 2023, if my numbers are correct, I think contributions into real estate funds outpaced distributions to the tune of about $350 billion.
Wow.
And that number should be in equilibrium to a certain extent. But people are contributing $350 billion more than they were getting back. So until that number started catching up, nobody was going to even look at real estate.
Well, there's no way to recycle the capital either if there's no capital coming back.
Yeah, exactly. So the drumbeat has gotten so loud. Every conference I was at, there would at least be one LP who would be sitting on the stage being like, hey, managers, please give us some money back. So we'd love to support you still, but we can't support you. So that has gotten closer to equilibrium now. And I think that will continue to help folks gain some support, right, internally from their CIOs and from their investment committees to start going back into the real estate market in a fairly major way. But, it took a while, right? But we are where we are now. And again, that's why we're feeling pretty good about 2026, because things like that have worked themselves out.
So what are the fundraising timelines? Are people still facing longer timelines for raising and closing funds? Are there higher closing rate hurdles, or are they coming down a little bit?
I wish I could say timelines were accelerating, Jeff, but I would say for the first time in my career, we've eclipsed 2 years on the fundraising trail. Wow. From first close to final close. It used to be, depending on what numbers you want to look at, 12 to 15 months. But that's increased significantly. But it's increased significantly because of all the things we've already talked about, right? Will that hopefully come down in future years? I'd like to think so. But it's also a situation where people don't want to make a mistake. And you can't fault an investor who's going to make a 10-year commitment of their money to someone to take their time, right? To really understand that manager, underwrite that manager. And when you have a mature portfolio, you're probably only adding around the edges. And when you're adding around the edges, you're going to be able to have more time to spend on diligencing those managers.
So what differentiates managers who are successfully raising capital in this environment, would you say?
I would go back to my transparency comment, right? I would say first and foremost, true north for any manager should be transparency and over communicating with their investors. Again, every time we go out and talk to LPs and our clients, if we asked folks that come into our office who aren't clients yet, and they would tell us the number one thing they think they need to do is deliver returns, which you absolutely need to do. But you need to deliver returns and do a lot of other things. And I would say that transparency always trumps other things when you're talking LPs. And I think the folks that have communicated with their investors, have done what they said they were going to do, will be well rewarded going into this next fundraising cycle. And I would say folks that have gotten money back to their investors too. right? Going back to what we said previously. I feel like there's a social contract that's signed between investors and managers, and they'll dollar cost average in, but they'll dollar cost average into two funds without maybe getting too much in distributions. But that third fund, they're not going to give you more money for that third fund unless that first fund is selling off, right? And you haven't seen that first fund sell off. You're starting to see it. But until that first fund sells off, how are they going to give you money into that third fund?
Now, would you say investors today are favoring established managers over emerging managers, or is there room for new entrants? And also, along with that, Rob, I would say, over the last couple of years, we've been hearing a lot of investors say at our board meetings that they're really preferring to re-up with existing managers. So even if they weren't emerging managers, if you were a manager they weren't doing business with, it's really hard to grab their attention. Is that changing at all?
I would say on the fringes, yes, if you're bringing something to the market that it doesn't already have, right? Going back to digital infrastructure, a lot of those groups are quasi first-time managers or, in their second fundraise, just because the digital infrastructure space didn't really exist in the mainstream until, the last 3 to 5 years. Some of the data center guys would slap me hard on the wrist for that because they've been in business, since the mid 90s. But I would say the institutional investor base hasn't really woken up to that space until relatively recently. But outside of that, I would say traditional closed-end commingled funds, folks are mainly staying with their stable of managers, and there's no real reason to change. But there's also lots of different ways for capital to aggregate around interesting opportunities in the market outside of the fund business, right? I mean, you've been doing this a heck of a lot longer than I have, and I've been doing it pretty long. And it used to be commingled closed-end fund and some open-end funds, and we're on our way, right? You go and talk to 20 consultants, you go talk to 50 investors, and you raise your closed-end fund. These days, you're going to talk to a lot more investors than that. You're going to talk to a lot more consultants, right? There's, 50, 75, 100 consultants, whereas before that really matter, whereas before it was, 10 to 15. But the development of things like the secondaries market, right? Where we have a lot of conversations with clients who come in our door who have maybe a high net worth syndicate, or they're in JV structures, they're a high quality operator, they say we want to raise a fund. We say, great, try to figure out why they want to raise the fund. It really makes sense for them to raise a fund, then also lead them in the conversation of there's lots of other ways to aggregate capital around your opportunities. And if you have a great portfolio that makes sense and fits a narrative to recapitalize, a lot of these groups that will recapitalize that portfolio will also give go forward capital, right? So if what you're really looking for is that go forward capital with some sort of discretion, you can potentially do some sort of recapitalization with one of those groups, or club structures have come back in vogue to a certain extent, or funds of one. So there's lots of different ways capital is aggregating around real estate. But I would say with regards to traditional closed-end commingled funds, it's really hard to break into that space right now.
No. So let's bring this down to earth in terms of, we've been talking from a pretty high level. Specific advice for managers. What common mistakes do you see managers make the most often during fundraising?
I would go back to communication, which obviously, Jeff, is a big thing for me since I brought it up so many times. But from where we sit, and for no other reason than I've been doing this since 2004, I've sat in a lot of meetings, and you get a sixth sense about what works and what doesn't work. And I think folks, when they're out on the fundraising trail, have to appreciate that they're going to kiss a lot of frogs, that it's a marathon, it's not a sprint, and that every single conversation is important, every coffee is important, how you present to the lowest common denominator, whether it's the analyst up to the CIO, is important. And you can never take a meeting for granted or an interaction for granted. And you really need to make sure that at the end of the day, you are clear, articulate, and treat everybody with respect, and appreciate that all these folks that you meet with might not be investor today, but they can be investor in 7 to 10 years. And you're in this business for the long haul, and they're trying to find relationships where they're going to give somebody money for 10 years. And that is critically important. That's what we always tell our clients. It's at the end of the day, we do a lot of gospel spreading, and that gospel spreading is important. And even if they're not an investor today, you want to line them up to hopefully be an investor in the future. So I would say that communication and really treating every single meeting with the importance that it deserves is very important. I think people at times lose sight of that.
So what advice would you give a manager of a first-time fund? How should they be looking at what they should do and what they should avoid doing?
When they're trying to fundraise?
Yeah.
Yeah.
Or
First,
maybe when they're structuring their fund as well. I mean,
yeah,
that's all part of it.
yeah. No, agreed. I mean, the first thing is, should you be a manager of closed-end capital, right? Discretionary capital. And is that what you want to do? We have so many folks come in to our office. I said we've did 391 unique meetings with GPs over the past 18 months, and we've taken on 2 or 3 new funds in that time frame, just to show you how high our bar has to be in this environment. But also, extrapolate that onto the managers. They need to make sure that the bar is pretty darn high for themselves. And they have to really understand what it means to be a fiduciary and what it means to wake up every single day thinking first and foremost about those investors, those teachers, those firemen, those government workers that they are investing on behalf of. So we have a lot of folks who come in our office and you start talking through it with them, and another capital aggregation strategy makes a lot more sense. But then there are certain folks that come in the office that truly want to be a fiduciary and woke up wanting to be in the investment management business. And those are the folks that get it, and those are the folks that we rally around, right? And there's lots of ways, again, to aggregate capital around opportunities. And there's so many different sources of capital for folks. But to really, truly want to be in that closed-end discretionary fund business, it's a pretty special something that you really need to understand and be committed to, because it takes a long time and it's extremely expensive to be in that business. It's rewarding at the end, but it's a slog to get there.
So what's the appetite for one-off joint ventures and programmatic joint ventures? I assume that's part of your business as well.
Yeah, I would say the appetite has increased over the past 5 years as investors get larger, as their portfolios become more mature, as control becomes more important, as fees become more important to certain investors. There will always be a space in investors' portfolios for closed-end commingled funds. And a lot of investors just don't have the staffing to do anything but invest in those closed-end commingled funds. But a lot of those investors, even in the closed-end commingled funds, want co-investments right next to the closed-end commingled fund, or would like to do some other things with the managers that they've invested in funds with. So I would say the appetite has increased as investors' portfolios become more mature, and has the interest in lowering fees and increasing control from the end user investor has increased.
And talk just a little bit about some of the other alternatives to closed-end funds for raising institutional capital. What's the appeal to investors of each one, and what types of investors tend to gravitate to those different types of alternative investment opportunities for them?
So I would say your smaller defined benefit plans. I actually sit on a small defined benefit plan. We have about $2.5 billion. We will never be able to do much more than just invest in funds, right? And I would say those smaller groups, it's just inefficient to invest outside of the closed-end fund structure. I would also say, though, that we do a little co-investing as well, which is something that's new for our fund. And as a smaller fund, I think you'll probably see some of the other smaller funds do some co-investing. But I would say smaller investors, your closed-end commingled funds, your open-end funds, that's going to be your way to gain access to the real estate market. I would say as you tick up into the larger investors, those are the investors that will look for JVs, will look for fund-to-ones, will look for some more controlling structures, because they feel like they have the expertise in-house and the staffing to be able to control the real estate, understand when they should exit real estate. And also with the folks in-house, there's it's more expensive, right, to have bigger teams. So they want to cut down on fees on the manager side. So if you're going to be in a kind of controlling position in real estate, you'd like to think that your fees will go down as well. So I'd say the programmatic JVs, as you said, the fund-to-ones, that's going to be a bigger investor game. Or you'll see some of the consultants provide that resource to their investors. So they'll aggregate some of their smaller investors and provide a OCIO type format, right? where they act as a larger investor because they're able to aggregate the smaller investors underneath them and execute on some of those programmatic JVs. One other thing we haven't talked about at all, which is something we're watching closely, and that I know you're watching closely, is the entrance of the high net worth investor into the real estate market.
The private wealth advisory market.
Yeah, and I mean, take defined contribution and put it to the side. Just the high net worth market, which $35 trillion in the high net worth market, which is about the same that's in the institutional market. And in the institutional market, call it 10% is in real estate. From the numbers I've seen of that 35 trillion that sits with high net worth, about $1 trillion is currently in real assets, and it's supposed to grow to about $2 trillion to 2030. So I think that adds a whole different source of capital, a whole different potential structuring situation. And it's just a really interesting something to watch as we all sit here and watch the real estate market recover and are looking for different ways to aggregate capital. I think that capital has become much more important, which is, has its pluses and minuses, depending on which seat you're sitting in.
Okay, well, we have people from the private wealth side, people from the real estate operator side, people from the investment management side, and investors that are listening into this. I'm going to ask you, the final question will be a city slicker type question. What's the one thing that you want people to take away from this?
I think the one thing I want people to take away from this is it's been a tough 2.5, 3 years in the real estate business. I think from where I sit, again, we have a very privileged position because we get to see the end user investor all the way through the largest investment management firms and what they're doing. I would say every single touch point along the way is pretty bullish about real estate. And we're starting to see that show itself in transaction volumes picking up and fundraising picking up. So we were in a capital markets winter, for lack of a better term, for the last 2.5, 3 years. And I think the green shoots that we're seeing, we're pretty darn excited about what 2026 and 2027 has in store for us. So that's the one thing I'd like people to take away.
And that's great news. Listen, if somebody wants to get a copy of your report, can they email you to get it?
Yeah, absolutely. They can email us. I'm sure it's on our website. We'd love for somebody to engage in that report. And if anybody has anything they want to talk about, it's a long life in a small world, and we're always happy to have the conversation.
Terrific. Thanks, Rob. Thanks for joining us.
Jeff. Appreciate it.